Can't believe people put this stuff out on the internet.
CPA and accountant is a complete idiot, and here's why.
Oh boy.
This is the software to use to make all of your income non-taxable.
That'd be Exhibit 1 if I was the government prosecuting this guy. He's got promoter liability with anybody that follows this advice.
If you're a 1099, you don't have to worry about this because you're not going to fill out a W-4. You're just going to stop sending in the money that would be taxed.
Caleb, she has a nice robe. They do all these weird arguments, and then everybody goes to jail. And then people follow them. I don't understand this. Somebody will see that and think, hey, you know what? I should promote that again because they just didn't argue it right. Caleb, it doesn't matter what you and I think. It matters what the Supreme Court thinks and what's going to happen to you. You're looking at jail time. That's who matters.
Toby Mathis, welcome back to the BetterWealth Show.
Hey, thanks for having me.
We are going to be reacting to some gems on TikTok and Instagram. They should probably be a sponsor of this, okay? Because they're making this episode possible. And most of these claims are pretty much saying how you can live the tax-free life. And I don't know about you, but I want to live the tax-free life. And so without further ado, let's dive in. We're throwing a lot at you, but I would love to get your opinion on just what they're saying and if it passes the BS test.
Good morning. I'm tax exempt. Let me tell you how I did it. First, I checked the federal tax exemption box on my W-4. If you're a 1099, you don't have to worry about this because you're not going to fill out a W-4. You're just going to stop sending in the money that would be taxed. Then I calculated how much of my income every month is taxable that the government would take out. Then I took that money. It's no longer being taken by the government. I put it into a high yield savings account. With that money in my high yield savings account, I am going to open up a tax deductible, socially responsible 401k. I'm also going to be starting my own LLC, in which I will be writing pretty much everything off as a business expense, so it can't be taxed. There are so much more information about these things if you'd like to learn more. We did just release a podcast episode detailing all of these things more in depth. There are also links in my bio for websites that can help you if you want to not pay taxes anymore to the federal government. Check it out.
Oh boy. Where do you want me to start on that one?
Well, it's the I'm tax exempt. Believe it or not, I know multiple people that have tried to do like the sovereign citizen, just not pay taxes. And I thought we would start with the easy one. Can I just check a box that I don't have to pay taxes?
Yeah, you can check a box, but it's subject to criminal liability for fraudulent activity. There's fines, civil and criminal, but it's kind of like you can click that you're exempt if you didn't pay taxes in the previous tax year and you don't expect to pay tax again. That is possible. So if you don't normally have to pay taxes and you don't think you're going to have to pay taxes because you make so little money, you're beneath the threshold, the standard deduction, like, hey, I'm making $10,000 a year, then you could check that because they're not going to withhold because you're not going to have a tax liability. But if you're doing it like this person is suggesting and like they're going to infer that you're checking that box subject to the rules that are listed there on the form on that W-4. And you're making a statement, and I believe it's under penalty of perjury. So I think you get yourself in a lot of hot water. But I think it was last year, there was about 700,000 refunds that got tied up with the IRS over this stuff where they were auditing somebody's exemptions and it was tying up their refunds as a result. And so I think it was a large number. It was over 700,000. I remember that. I don't remember the specific outcomes, but they were putting these people through the ringer. So be careful on that one. It's fraud. There's civil penalties and there could be criminal exposure.
All right. So check the box at your own risk. You heard it first. What I found was interesting is she's talking about I'm tax exempt, but then she's also talking about tax deductible 401ks and deductions in her LLC. And I'm like, all right, I feel like, am I the only one crazy here that says like, maybe you have no idea what you're talking about? Because if you don't have to pay taxes and you figured that out, why do you care about those things? But maybe I'm giving her too much credit by reading into those things.
Caleb, she has a nice robe, but the 401k is an employer-sponsored plan. So I suppose she mentioned LLC, which is not a tax designation. So assuming that you just do it the lazy way and you don't actually choose to be a corporation or you're not a partnership and maybe you're just ignoring the LLC, a disregarded LLC, and you have a 401k, you could do that and you could even defer your income into it, but it's still subject to employment taxes. It's not like you're going to get to zero. You still have the Social Security and the Medicare, old age disability survivors insurance and Medicare. So it's not like you're getting away from all taxes and you're getting down to zero, like a lot of these folks say, even if I defer it, which I'm a big advocate for, 401ks are great, that's different. And then when she says, hey, I'm going to write everything off, you can write off reasonable and ordinary expenses that are for the pursuit of your business, legitimate, like reasonable and ordinary for that business. Just saying something's a business expense won't cut it. And especially if it's personal in nature, it gets denied all the time. It's all these influencers are out there saying, hey, get a haircut and my clothes and my Rolex and all these things. It's like, no, that's inherently personal in nature. It's going to be disallowed. Section 162 is the ordinary necessary business expense statute. But if it's something that is personal benefit, then it's not going to be a deduction in many of those cases. So they're going to look at those things. So it's not like you can write off, hey, I'm going to eat and I'm going to say I'm doing business. It doesn't work that way. You're going to get disallowed. These folks that try to write everything under the sun off or tell you to do things like, I'm going to take my family out or I'm going to hire a private chef. No, this stuff doesn't work, guys. The IRS literally has cases in their pocket where they've disallowed. There was one case that always comes to mind. It was a guy who was running a legitimate business. I can't remember whether he was an accountant or an attorney or whatnot, but he was taking his staff to lunch every day. And they said, too many lunches, that becomes personal. It's no longer business related because you're doing it too often. And so again, think about what this gal's saying. I'm going to write everything off. Yeah, no. Even if somehow you could twist it into somehow this is part of my business. No. I think if we get enough comments, if we can get you to wear a beanie, maybe more people will listen to your advice, Toby. So that might be, let's see if there's any traction in the comments for that. I don't even think I can write the beanie off. That's the problem.
I'm with you. All right. This next video is, this person came up all over TikTok. So they got the TikTok thing down, and this is how to never pay another dime in income tax again.
As we all know that our U.S. tax system is a voluntary tax system, and
So we all know the U.S. tax system is a voluntary tax system. We're all starting to hear that lately. But how do we actually do something about it? What process do we use to opt out and get all of our money refunded? Once again, the process that you want to use is the 12411 process. Now, what is 12 U.S.C. 411? Title 12, United States Code 411 states that your Federal Reserve notes, which are the default currency issued in the United States and are taxable, you can redeem them on demand for United States notes or lawful money, which is non-taxable. This is taxable. These two are non-taxable, and you have a choice to declare your income as either one on your taxes. Step 1, look in box number 2 on all of your W-2. Add that amount up because that's going to be your total refund when the 12411 process is complete. Now, typically, everything you made over here in box 1 is considered taxable. We need to change that. I'll show you guys how it looks. This is the 12411 process, version 6 by Wealth Guaranteed. This is the software to use to make all of your income non-taxable every year from now on and get a 100% refund of all of your taxes. Instead of it being perceived as these taxable Federal Reserve notes like everyone else, your income will be perceived as these non-taxable United States notes. Then once that's done, let the no tax pros at Wealth Guaranteed prepare your tax returns. As you can see, every single penny of what they took out for federal and state taxes is what we requested as a refund. The amount that we paid in taxes, $0.00, not a single penny. Here's the check, about $15,000 freezing the 12411 process. And if that isn't enough for you, I've got the cash right here. 12411 process by Wealth Guaranteed. This is a 100% refund of every single penny that I paid into the tax system. I haven't paid taxes since 2020. I've become 100% non-taxable, and this is the process I use. Join the free class tomorrow. Learn how this process works. Learn how you can apply this for yourself. If you already paid taxes this year, so be it. It'll be your last year ever paying again. See you on tomorrow's class.
I can't believe people put this stuff out on the internet, because that would be Exhibit 1 if I was the government prosecuting this guy. He's got promoter liability with anybody that follows this advice. I can write whatever I want on a return. Your filing is voluntary. I am voluntarily filling out my return. If you don't file your return, you can be prosecuted for willful failure to file your return. Payment is compulsory. So when you say, hey, voluntarily, what the IRS is saying and what the courts have always said is, yeah, you're doing it yourself. It's you. Like, I prepare my return. It's voluntary. If I choose not to file and I have a tax liability, that's a criminal act. So I starts off as a misdemeanor and goes right on up to felonies pretty quick. And, remember Wesley Snipes? And there was he followed one of these guys. Wesley Snipes was in all these movies in the 90s, the 80s and 90s, Blade trilogy, really famous actor in my generation. I don't know if you guys know who he is, but he got hit. I think it was 3 willful failure to file. They gave him a year for each one. I think he did 28 months in the federal penitentiary for following this type of advice. And the court said, I don't know. He got away from one of the, like some of the higher penalty, like the felonies that he was charged with. The promoter didn't, but he did, because they said, hey, you reasonably relied on this guy. Like, we don't believe that you really wanted to commit the felony, but they gave him a year on each count for the willful failure to file. And so what these guys do is they kind of do this, hey, you can write any number in that box and you could say refund, or I have an expense, or, how much tax do I owe? 0. So give me a refund for the rest. You can do that. That's a crime. And then you get the money back and you can hold a big stack of cash, and there's not cash that's non-taxable and cash that is. That's not a thing. When we talk about 12, I forget what the section
is. Like 12, 4, 11. Yeah.
That you're talking about, that's currency. We're talking about types of currencies and things like that. We're not talking about taxation. I don't care whether it's Bitcoin or I pay you in chickens. It's taxable if there's something of value that's been transferred. The Supreme Court's been unequivocal about that. There's not a single case that a taxpayer has ever won where they said, what you paid me in legal tender and it doesn't qualify, or it was reserve notes and that doesn't qualify. You need only gold, or you paid me in gold, so it wasn't in legal tender. Like, they do all these weird arguments and then everybody goes to jail. So it's one of those weird things. And then people follow them. I don't understand this. Like, there's folks that have done this that have been prosecuted and go to jail as a result. And then somebody will see that and think, hey, you know what? I should promote that again, because they just didn't argue it right.
Yeah, they didn't do it right. Yeah. I can't remember the name, but I think there was someone from Michigan that had this whole movement that they were teaching people how to do that. And they actually went to jail, and then they became almost, kind of like a martyr kind of deal, where people would be like, rebelling. I've also seen there's a trend right now. I think it's a joke, but I think it's becoming less of a joke, where people are just like, why don't you pay your taxes? Like, if we all stop paying our taxes, it's kind of like the Tea Party concept. It is just interesting to see like what people are saying. And this person makes the claim that they haven't paid taxes since 2020. And I imagine that they're helping lots of people do this. Number one, how is the IRS how have they not flagged this already? Like, shouldn't it be an automatic flag, or is it because there's so many things in the system? Like, is it common that people can get away with this for years and years and years? Because that's part of credibility that they're using, is the years and all the money. And so I'm just wondering, when does this usually get, sniffed out, and when does it, what's the saying, like the chicken comes home to roost? Like, when does it usually get blown up?
When the IRS finally sees it and it gets referred to CID. Okay. So a very small number of people, it's like 0.2% get audited. It's a very low amount. And if I don't file, they would have to have somebody report something that triggers, and then they might send you, here's what we think your return should be. In this case, this guy's saying, hey, let's file your return and we're just going to claim a refund for everything. We're going to say, hey, we have I can remember if it was a deduction or he's just filling in, your taxes owed is 0. And so he's claiming some massive deduction. Well, okay, so they just haven't come across it yet. There's millions, tens of millions, over 100 million taxpayers, right? And there's all these tax forms. Eventually, the percentages are going to catch up. Some of these folks, I've had them come into my office and they'll be like, I haven't paid taxes in 20 years. And I'm like, okay, there's a lot of bank robbers that got away with it too. There's a lot of people that have committed all sorts of crimes and didn't get caught. Eventually, usually it catches up. And especially if you're posting TikTok videos of yourself advocating the breaking of laws, then eventually it'll come around and there'll be a time for him. But there's so many. There was one, and I'm trying to remember the name. And I think it might be the one you're talking about, where he didn't believe that you were supposed to pay taxes. It was this whole kind of this voluntary thing.
Yeah, it was unconstitutional. I think his argument is. Yeah,
I'm trying to remember the name, but the gentleman ended up getting cancer in prison and passing away. And because of the federal system, he was still being chained to the hospital bed. And towards the end, and they were like, see, he's a martyr. They killed him. And it's like, you're a federal felon.
Yeah.
And you had a whole bunch of people follow this. And it may be you may honestly believe it. It doesn't mean that it's not a crime. Like, I can honestly believe that it's okay for me to hit you, and that I have a right to hit you. But society says, no, physical contact causing harm, this is a crime. And it doesn't matter, hey, did I mean to break the law? No, I meant to hit you. And that's a crime. So when I don't pay my taxes and I come up with some cockamamie idea, I may honestly believe it. It's still a crime.
Yeah. What would you say to the person that might be watching this that has done this in the past, might be years of not paying their taxes? Like, how do you unwind that? And if that's for a different video, I'm just curious, like, where do you even begin if you're watching this and kind of saying like, oh man, I was deceived, or I need to get this thing unwound?
It's not unwinding it. It's actually winding it. Like if I have not been paying taxes, I need to get my transcripts. I need to get with somebody and file those taxes. Because the difference between a criminal action, because it's a misdemeanor failure to file, period. And then if you do it again for multiple years, or if it's over a certain dollar amount, it kicks it into felony. And the more tax liability you have, the bigger the penalty. Like you can go to jail a long, long time on tax evasion or failure to file. So if you haven't filed, you're already like, oh, you've committed crimes. Now, whether the IRS is going to keep it civil or refer you over to CID is going to be dependent on whether you voluntarily say, here's what I owe, and make a good faith effort to negotiate it or to pay it. Or if you're going to if they catch you and, hey, I'm just not going to do it. Then if they catch you, chances are they're going to prosecute you. They're going to refer it straight over to the criminal investigation department of the IRS. Usually that's what happens. If civil agent finds and sees evidence of a crime, they refer. And then CID comes in and says, is there a crime committed? And they prosecute, or they choose to prosecute. So there's some discretion there. If you're coming to them, that's a much different story than if they find you and they say like, oh my gosh, this Caleb guy, he hasn't filed in 10 years and we've caught him. But if you had gone and said, hey, I didn't file, I'm filed now. This is what I owe. I can't pay it. I'm trying to pay it. I need a payment plan. But you start the discourse. It's a different story.
Okay. That's great. And yeah, thank you for breaking that down. The next video we're going to review is someone that says you should build a house every 2 years and it's a way to live tax-free and stop working. And I actually know people that do this. They don't necessarily like make it the tax-free nature, but they swear by this strategy. And I'm curious your take on this.
Want tax-free income? Build a house every 2 years. Live in it. Sell it. $250,000 tax-free. $500,000 if you're married. You wouldn't even have to work a job. Just build a house every 2 years. After the first 2 years, you sell that house, live off the rest of it, and build another house.
For the last 6 years, we've been on a mission to change the narrative about money and life insurance and help our subscribers live wealthier and a more intentional life. But my producer just told me something wild. Over 70% of you watching right now haven't subscribed to the channel. So whether you're brand new or one of our longtime viewers, if any of our videos have helped you see things differently or provided value to you in any way, I would love for you to subscribe as we're trying to reach 100,000 subscribers by the end of 2026. We've got some incredible guests and conversations planned for 2026. I don't want you to miss them. I'm so grateful for each and every one of you who support this channel, and I'm excited to continue this journey with you.
Okay, Caleb, I want to do two things here. Number one, this idea of tax-free has consequences. When my partner and I, Clint, when we started Anderson, close to 27, 28 years ago, whatever it was, the first few years, there's some tax maneuvers you can do with accrual-based accounting, things like that, where you can get your income way low and sometimes down to zero. It depends on the tax law, and it depends on which type of tax. Like I can't get away from employment taxes if I'm paying myself a salary. There's no deduction that offsets that. But I can sometimes get my federal income tax down to zero. Sometimes with things like you're going to hear real estate professional status, short-term rental loophole, through a series, hey, running a business and creating losses and things like that. There's limitations on that. But let's just assume that you got yourself down to zero. There's consequences to that. You can't get a loan.
Yeah.
You're going to go under, I want a mortgage. Yeah, forget it. Like those things have consequences. Then you're going to say, well, at least I'm not paying tax. I'm going to do this. Sometimes it's pay the least amount you're legally required or that behooves you. And so, I always think like 200,000 is kind of like the magic number. If I'm underneath, I'm not really paying that much tax because it's a graduated system. You start at zero and then it keeps tacking on. So people think that I'm in the 32% tax bracket. I'm paying 32%. No, you're not. You're paying it on the amount of money over that threshold. You're going to get taxed and you start getting into tax pain. But your overall tax, if it's below 20%, I'm really not that worried about it as an individual. Maybe you are. Some people are different. But if you're 100,000 or below the 200,000 mark, you're not in a lot of tax pain. Yeah, it might be annoying, but it's not like putting your hand on there. So let's go back to this guy. So what he's talking about is Section 121. And that's a code provision that allows you to sell your personal residence if you've lived in it for 2 years of the last 5. And then there's some exceptions if you're forced to move, you're military, some things like that. But generally speaking, the way to think of it is, hey, last 60 months, did I live in it as my primary residence for 24 months? And notice I said any of those 60 months. It doesn't have to be just before I sell it. I just did this last year. I had sold a house that I had lived in. I rented it for just going on to 3 years. And I was like, do I want it was right at the threshold. If for a married couple, it's $500,000. And I was like, I'll just take the $500,000. I don't have to pay tax on it. Great. I did have a little deep depreciation recapture because it was a rental, but there's other ways to offset that with passive losses. But the point is that he's saying, hey, if I live in a house for 2 years, he didn't say that. He said, build a house and live in it and then sell it. And that's a very different scenario. That sounds to me like a developer. That sounds to me like not somebody this is my personal residence and I sell. And as long as every 2 years, I can qualify for this 121 exclusion. If I'm single, it's $250,000. If I'm married, it's $500,000. It's a great benefit if you sell your personal residence. But what he is describing is building a home, living in it, and then selling it. And that's actually what's called a dealer. In a dealer, you don't have capital gains anymore. In a dealer, you have ordinary income, and it can be subject to employment taxes. And you see this with people that buy, subdivide property, build houses, and they're like, it's capital gains. No, it's not. You are a trader business. Your intent when you bought that was to build it and sell it. He just said so. Like he just literally just said, hey, build it, sell it, you live off of it. So what was your intent when you bought the house? To live in it? Was it your residence? No. Was it an investment property? That's another, like there is a way to qualify. If it's like a 1031 exchange, you could still make that your primary residence, but then Section 121 says you need to live in it for at least, I think it's 5 years. Like they make it, or you can only do it every 5th year. Like they put another layer of restrictions on it so people don't abuse it. But that's not what this guy said. What he said is, you heard him, build a house every 2 years, sell it, you don't pay gain. That's not true. I believe the IRS would have a very strong argument that his intent when he did that was to build and sell a home. He would not qualify under Section 121 if that's the case. Now he could say, hey, wait, I didn't mean that. I didn't mean build a house. I meant buy a house and fix it up. Yeah, just be careful because the intent is what they look at. When you buy a house, if your intent's to sell it, then you're a dealer. If you buy a house and your intent is to hold it for long-term appreciation or to live in it, then you're either an investor or personal. So if I buy a house and I live in it and I'm somebody who fixes houses up and I like to do that and I like to redo the yard and I buy new appliances and stuff and I sell that, absolutely I qualify as a Section 121 exclusion. But if I'm saying this is my job and I don't have to work anymore and I'm buying it or I'm buying land and I'm building it or I'm buying a tear down and I'm fixing it up, I don't believe that it's going to apply. I mean, we could try to argue it, but that's not the spirit of what that thing was about.
So the IRS will very much look at intent and say like, hey, are you intending to game the system? Because I believe that this is not meant to create a tax-free blueprint. It's meant to why do you think they have this rule in place?
I mean, it's incentivizing people to buy a home and continue to upgrade their home. It's a tax incentive for individuals.
Yeah.
There's not a lot of tax incentives. Like if you live next door to me and I am somebody who rents out a house, and so I buy let's say we have identical homes next to each other. You live in yours with your family, but I rent mine out as a landlord. I have Section 1031 exchanges available to me where I can, if that thing goes up $1 million, I don't pay tax on the million so long as I buy additional property of equal or greater value. But you, on the other hand, if yours goes up $1 million, you only get the $500,000 exclusion. I get to write off and depreciate the property and take a deduction. You get nothing. If I repaired my property as a landlord, I get a deduction. You get nothing. I get to write off 100% of the interest I pay on that property as an investment expense. You have to qualify on your Schedule A for your $750,000 limitation on the mortgage on your house. You have restrictions. I don't have that. Same house sitting side by side. The tax laws treat people differently. So the incentive here is to give you, Caleb, the person who's not the investor, this incentive. And if I, as an investor, come along and say, I'm going to abuse that, that's what I'm going to do. I'm going to get that house. I'm going to build, and I'm a builder, and I'm going to build a house every 2 years, and I'm never going to pay tax ever. I don't think that's not what it was designed for.
Yeah, I love it. All right. Speaking of houses, the next clip that we're going to watch is talking about cost segregation. And this is Carlton. And there is a lot of people out there that are talking about this as like the strategy. And I find that there's a lot of confusion. And so I wanted to tee this strategy up and get your take.
Here's how you can avoid 100% of your income taxes every single year. We call this strategy the paper loss strategy. In order to use it every single year, you have to understand the rules. The very first thing that I'm going to need you to understand is you're going to need to buy an investment property. When you buy a rental property, it could be an Airbnb or it can be a long-term rental. But as soon as you purchase the property, I want you to write off everything that's on the inside of the property. This could be appliances, bathrooms, tubs, cabinets. And when you write off everything that's inside of the property, it creates a big expense. We call this the cost segregation study. Once you do the cost segregation study, it creates a big enough loss to offset your W-2, your 1099, your stock, and your crypto income, making you tax-free. Comment below if you'll be investing in real estate to avoid W-2 and 1099 income taxes.
So Toby, what's your take on the cost seg strategy?
Cost segs are great. It's just a fast way to depreciate things. Let me do two things because I've seen all of his videos. Interesting character. It doesn't work the way it's very powerful. Cost segs are very powerful for a certain group of people. It's great. Like he's mixing investor. He's throwing Airbnb, which if you qualify, if it's 7 days or less, then that's a trader business. You're not an investor anymore, but you're more akin to almost like a hotel. But he's kind of conflating them. And when you're an investor in real estate, like with me, it's considered a passive activity. And so my losses can only offset my passive income. Passive income, there's only two types. It's rental or it is businesses that I do not materially participate in. And that's not what he's talking about. He's talking about your D2 or your 1099. Those are active businesses. So the only way what he is describing would work is if you're a real estate professional or you're doing an Airbnb and you materially participate in that business and you run an Airbnb and 7 days or less is the average daily usage. Then those losses could be unlocked. They're no longer passive. But in order to take a loss, you need to have a basis. You have to be at risk. And then we get to the passive activities. Like we still have to have those other things. So people that are doing subject twos, for example, get caught up in this and they don't qualify as being at risk and they think they have these losses from a cost seg study and they don't. People go out there, they buy these homes and let's say they're a high net worth person and they do these cost seg studies and they get this paper loss and it's passive and they can't use it. And they carry it forward and it'll be released. That passive loss that they don't get to use when they sell the property, it'll get released. Unless they're grouping, like there's some bunch of exceptions. If they're grouping a bunch of properties, then they have to get rid of them all. But that's not, Carlton does not say that. And then even if I get the loss in it, I'm a real estate professional, there's called a net operating loss limitation. This year in 2026, for example, for a single person, it's like 250,000. For a married couple, it's just over 500,000. It's not huge. And then let's just make it even more fun because I've seen him you had him on your show, I think you interviewed him. I think he's in California, right?
Yeah, that's correct. That's correct.
Yeah. California doesn't even recognize bonus depreciation. Like, so I always am shocked. I'm like, you're saying that you get to do these things. You're conflating federal and state. Like you're just making a blanket statement. Yeah, you can write off and pay zero taxes. No, you can't. Like there's so many limitations. You might be able to, but it is the sliver of an exception. And I guarantee you he's not paying zero taxes. I've heard him say he is. And it's like, I think you can't even have the loss. Like if you make $1 million in California, I think you don't even get to use losses. Like you're paying California income taxes, period. He might find that out when he has somebody to do his return, maybe.
And so you're saying federally that could happen, but you're saying the state of California, if you're a resident in the state of California, that wouldn't be able to help you on the state tax side?
The bonus depreciation, they don't conform. And they even limit Section 179. So you always see these people talk about writing off their car, buy a really heavy car. Yeah, good luck. On California, they're going to say you're capped at $25,000 under Section 179 and you don't get to use bonus depreciation.
Yeah, that's interesting. You're the first person I've ever heard that from. That's very interesting.
Well, everybody finds out at one point. Usually a year and a half later or whatever, when they're doing their tax, they file their extension and then they're like, why do I owe all these penalties? And I'm like, because you didn't pay your tax on time. I'm like, but I was zero. yeah, you're nuts.
Yeah. So I got a couple other questions. So when it comes to the real estate professional, because this has been a thing that I've even talked to people and they're like, hey, have your wife be a real estate professional. It's like the ticket to pay no taxes. And then the Airbnb thing is kind of falling apart because people are realizing that they're doing these things and it's like you're like letting the tax strategy determine where you should put all your money, but they're actually not making any money on the Airbnbs. And so it's not turning out maybe the way that they envisioned. Yeah. Talk to me about like, who should consider this strategy? Who should just stay in their lane? And then the other thing that I've seen you say before is no one's talking about the recapture aspect. And so is it one of those you can just 1035 or 1031 and not have to worry? Or do a lot of people have to talk to me about the recapture as well?
So let me explain what a cost seg study is, because he talks about all the components in there. So I think he had a bathtub. If I write off a bathtub, that's a 5-year life property. And I can bonus it under section 168K. And again, California doesn't necessarily conform to that, or whatever your state, like a lot of states, I think it's half of them don't conform. So it's a lot of issues there. But let's just say, hey, I get this big write-off, and I'm a big advocate. I love real estate professional status for the right situation. I just know there's limitations to it. You have net operating loss limitations, you have state limitations, you have other things, but it's still very, very powerful. But I write it off. I have 5-year property and I accelerate that. And let's say that bathtub is $1,000 and I get $1,000 deduction. And then the following year I sell the bathtub. I have $1,000 of recapture. That's ordinary income. Recapture section 1245 when it's personal property. That's not the big one that catches these guys though, Caleb. They talk about writing cars off all the time. They're always, hey, I'm going to buy a car and I'm going to write it off at the end of the year. I'm like, don't buy a car for a write-off. That's a horrible. Like you only get to write off the business use of it first off. And then to get the bonus depreciation, what he's talking about, where you write it all off in 1 year, it has to be primarily used for business, which means it needs to be more than 50%. If you fall below the 50% threshold in the subsequent years during the useful life of that vehicle, which is 5 years, you have recapture of all the bonus you took. Like you have to treat it like you straight lined it, like you wrote it off without the bonus depreciation, which would be a much smaller amount. So I use like $200,000 G-Wagon or something like that. See these guys always talking, a Range Rover. Right? How about 150 grand? And they buy it at the end of the year and they say 100% business use, which the IRS just doesn't buy. You have to track your miles, which trips you did, use Mile IQ for that one. Like, so that the Jeep does it, but we used to have to keep these little mileage logs and you have to write, what did I start? What did I do? Who did I see? Why did I drive for business? It's kind of a pain. But let's just say you did 100% business use. Congratulations. I would do like slow clap. Yay. You got a $150,000 deduction. What is that worth to you? 30 grand, something like that. You just spent $150,000. Let's just say it's a Range Rover. You lost that much money the day you drove it off the lot. So it was a horrible economic decision. And then the following year, you're like, I got this G-Wagon, but shoot, I don't have any deductions now. Like I just wrote it all off last year. I don't get to, would I have to buy another one? Maybe you give it to a significant other and you say, hey, you can drive it. Guess what? No longer 50% or greater business use. So almost the entire 150K comes back onto your tax return. You have to pay tax on it. So all you've done is spend a whole bunch of money to create a headache for yourself. I'm one of those guys that likes to keep it simple. I usually just do mileage reimbursement. Hey, I don't care how many cars you have, just reimburse the mileage. It's like 70 cents a mile and I can track that. And it's, the IRS isn't going to yell at you. It's not all this craziness that these guys are doing when they're trying to buy really expensive vehicles for the tax strategy. And it's like, come on, guys. I don't know if I'm being clear though. The bonus depreciation, I'm walking into a house and let's just say you and I, again, we're neighbors. My house is the investment. Yours is your personal. You walk over to mine. You say, Toby, I really like to see your house. And I walk you over and there's a nice white picket fence. There's a nice little walkway up to the front door. And I have a really nice patio in the back and a bunch of trees in the back. And I'm like, hey, Caleb, come on up. And you walk up the front door. You look at it. Wow, that smells like fresh carpet. Like, yep, brand new carpeting. Look at my appliances. It's all stainless. I'm like, yes. And I'm going to rent this puppy out. It's going to be the best thing ever. We walk out onto the deck and everything. The walkway up to the deck, the fence, the back deck, the trees, that's all land improvement. That's 15-year property, which means under 168K, I can write it all off in 1 year, but I don't know the value of that. That's what a cost segregation study is. It's just taking that. We go inside, the carpeting, 5-year property, I can write it all off in the first year. The appliances, 5-year property, I can write them all off. Anything that's attached to that appliance, that part of the home, even the electric and the plumbing, could be written off over the shorter period of time. And it's usually about 30% of the improvement value of a home, not the land, the improvement value. So let's say I buy a $200,000 house and 150 of it's the improvement, 50 of it's the land. We're talking about a deduction that's going to be worth 30% of 150. So about a $50,000 deduction. And that's what everybody's getting all excited about. I'm like, but it's a $200,000 property I just bought. It's passive unless I can qualify as a real estate professional. Is that really the reason I should be buying it? Or if I'm an investor, am I just saying, hey, as an investor, I can really get some accelerated depreciation to offset all my rents and other things that are coming in. And oh, yes, if you or a spouse qualifies as a real estate professional, if there's too much deduction in a given year, instead of just carrying it forward, we'll use it to get back some of your W-2. That's the proper way to think about it. But they don't. They just say zero tax and you could do this, that. It's a very small percentage of people that qualify as real estate professionals. It requires that one spouse on a joint return qualify under the 750 hour or 50%, or excuse me, 750 hours and 50% or greater use of their personal time test. That's what a real estate professional actually is. And then they also, both spouses together, have to qualify as materially participating on their rentals. And it's each rental property that you have to qualify for. So people group all their properties together and then they qualify. But the first test, that 750 hours, that's not small.
Yeah.
That means you have to be doing a real estate trade or business, which means you're construction, you're a builder. Go back to our builder guy. He might qualify. Maybe I'm a realtor. Maybe I'm a property manager. Individually, one spouse has to meet that by themselves. And then you look at your investment properties and say, now both spouses together have to qualify as materially participating, which can be 500 hours on the rental properties. It could be as low as 100 hours on those rental properties, so long as nobody's doing more, or you're self-managing everything. You're doing everything yourself and nobody's providing any other services. Then you could qualify. So there's all these tests that I just threw at you that never were addressed. And it's a cool video. It's great TikTok, and Carlton's got a great following. Congratulations. That's great. But you got to be asking yourself, am I doing more harm than good when I'm giving half truths out there, or sometimes just outright fabrications?
All right. This next video is titled How to Not Pay Taxes Legally.
Do not pay your taxes. Instead, do this legally. It's tax season and you made $100,000. Time to pay up. Nope. That's wrong. I actually don't owe you anything. Well, you made $100,000. You think I'm not getting a piece of that? I'll tell you why I don't. See, I bought that car for business and marketing. I also used the Augusta rule to rent out my house to my business. I'm also able to write off my travel expenses like my car mileage. Yeah, you so smart. You done talking yet? And because my business is an S Corp, 20% of my net income is not taxable. I even have a rental property and I could claim this much in depreciation, even though the house value keeps going up. So how can I rip you off? I mean, how can I tax you? I made $1. $1? Yeah, you must be watching Humble King Cast for all the money hacks.
Hey, am I crazy? But did he say he's wrote the car off and he takes mileage? Like, I don't know.
Yeah, you can.
Yeah, you can't do that.
You have to pick one or the other. But he did a lot of things in there that are just kind of crazy. Like the 20%, I'm like, 20% means you have net income. That's not zero. That's not $1. It means 20%. And then there's limitations on that too. There's phase outs. There's specified service businesses that, if you make too much and you can't do it, or you're calculated against W-2 and depreciable assets. Like there's all these little nuances, but they like to just go bleh. So 20% of what? That's what I would say. 20% of your dollar you get to write off because it's off of your net income out of a business. The rest of it is, yes, there's the Augusta rule, which is I'm renting it to a business, which it needs to be a separate taxpayer. So it's a C or an S Corp. You can write off the business use of your car. So you can't say like marketing. These people say I wrapped my car, so it's marketing. That doesn't work. The courts have already said, nope, that is not a valid. It has to be I'm using the vehicle for a specific reason to make profit. So I need to say who I'm meeting, why I'm driving, where I'm going, why I'm doing it, and what benefit it is to my business, or it's going to be disallowed. So that's why you have to keep that mileage log, and you got to keep a record of why you're using it for that purpose. Now, there's exceptions. Like, I don't want to get into too many nuances, but like if you're traveling between two offices all the time, okay, yeah, the IRS isn't going to hound you on that. But if you're driving around and you're saying, hey, I use my car 100% for business and I wrote it all off, okay, that's great. But remember, a deduction doesn't mean a tax credit. A deduction means if I had $100,000 of income and I got a $10,000 deduction, now I have $90,000 of income. And if that's through an S corp and I have net income of $90,000, then the 199A deduction just means I get an $18,000 deduction on top of that, which would be $72,000 of income. That's not zero. And then you're right. You can't write off mileage if you're writing off the vehicle under the actual expense. You have to choose. Yeah.
And I'm making a healthy assumption. I don't think many of these people on TikTok have two offices that they have and that they're driving into. But yeah, that's it. I appreciate you breaking that down. And I find that some people, again, they push S corps, which can be great, but not everyone that's starting a business should go right into an S corp. And the Augusta rule can be a great strategy as well, but you have to do it properly.
Can I just interject? Because I wrote an article on the Augusta rule in 2001. I still remember doing all the research on it. And at the time it was very controversial. And there was cases, there's been more cases that have come out. And the IRS will let you write it off so long as there's actual business usage. So the Augusta rule is a fancy way of saying we just had the Masters last month. So it's like, oh, it's timely. They call it the Augusta rule because the idea is that there was a senator or somebody advocated for their patrons or their constituents, and they were renting their house out, and they lived by where the Masters is played in Augusta. So they were renting their houses out for these obscene amounts of money during that week, and they didn't have to pay tax on it. And that is absolutely true. I can rent my house up to 14 days. That's it. 14 days, not every day, not rented under a lease, but up to 14 days. And I don't have to recognize it as income. That's it. That's 288, subsection G2. It's very clear. So if I use the house as a residence, it's not for my investment properties. It's for a house that I use as a residence. And it could be a second home. It could even be an RV. It could even be a boat in some cases. But if I rent it to a third party, another taxpayer, then they can pay me for it and I don't have to recognize it as income. Okay, that's great. That's a little bit of money. It's the fair market value of whatever that is. And that other taxpayer could be the corporation having a meeting there, and it needs to be an actual meeting in your home. And so, yeah, you see people do this all the time that have S&C Corps or LLCs taxed as S&C Corps, and they say, let's do our monthly meeting in the home. And to those folks, I say, great, go get your quotes from other accommodations, figure out a reasonable amount. And then if you do that, you don't have to recognize it as income. That's fantastic. It doesn't get you to zero though.
Right. Yeah, I agree. This next TikTok is we're going back to one of our favorite tax TikTokers. Why paying tax is voluntary, not mandatory.
So I have a bunch of people who comment under my videos and say, I looked it up. Taxes aren't voluntary. I saw it on the IRS's website. The first result on Google. You're being gaslit. They expect you not to look deeper. If you go ahead and look up on the IRS website, do a little bit more research. Why are they using the word mandatory? Why don't they say mandatory tax compliance? Please show me where they say that. Taxes paid voluntarily and on time. Why don't they use the word mandatory? If it's mandatory, why don't they say that? That would be a much more effective way to communicate. Why don't they say that? Don't miss it. Don't miss it. Voluntary tax compliance rate. Don't miss it. Don't miss it. So why aren't they using the word mandatory? They have the choice to say that. Why don't they say it's mandatory? Okay. Let's look at the IRS criminal investigation data. These people know the law. They enforce the law. They know what the law says. Let's see what it is. 2017. Scroll down, zoom in. What does that say? Compliance with the tax laws in the United States depend heavily on taxpayer self-assessment, the amount of tax. Voluntary filing of tax returns. I can't make it up.
Don't miss it, Toby. And according to him, you're gaslighting him. You're gaslighting the public.
Okay, so I'll just tell you which there's a law on it. I think it's 6012, IRC 6012, mandatory requirement to file. You voluntarily produce it, like you created it. The IRS does not send you a bill. You file your return. They compare it to what they have, and they will sometimes scrutinize your return to make sure you're being honest. That's what they're doing. It's voluntary compliance. Mandatory tax filing, mandatory payments of taxes. Yeah. Plenty of court cases. Supreme Court decided it. So he keeps like, why are they gaslighting you? Excuse me. The IRS is being true. We file voluntarily.
Yeah.
Did anybody walk up and put a gun to your head and say, file that return? No, they just said, here's the ramifications if you don't. If you have no tax liability, no ramification. If there is a tax liability, you're looking at misdemeanors and felonies.
Yeah.
And then you have to pay your taxes. There's nothing what he said is voluntarily pay your taxes. That's not what they say.
Yep.
It's voluntary compliance with the filing of the forms with the tax laws. You have mandatory payment of taxes on income under statutes. So sorry, it's again, these guys get on, they see one thing and they're like a dog with a bone and they quit reading. Yeah, the IRS is telling you the truth, but it's not what you think.
Yeah, you're taking one word and you're like getting all excited about voluntary, but you're misrepresenting what that means. And you laid it out really, really well. And so hopefully that this video can open some people's eyes.
Caleb, it doesn't matter what you and I think. It matters what the Supreme Court thinks and what's going to happen to you.
Yeah.
It doesn't matter what he thinks. It matters when you're being judged and you're dealing with the consequences of your actions. And there's huge fines. There's penalties up the kazoo. Mm-hmm. You're looking at jail time. That's who matters.
Right.
What do those folks think? And the IRS is very clear. Here's what we think. The Supreme Court says we agree. And there's a 16th Amendment. All these people are like, you don't owe taxes. Yeah, I think it was 1913. We have an amendment to our Constitution that says, yes, you do.
Yep. I love it. This next video, it's always interesting. The people that I believe are, doing really, really sketchy things, committing fraud, also are very in your face and like very confident. And this video is literally titled, "Your CPA is an Idiot." You're going to love this guy's energy, but I would love to get your take on complex trust.
CPA and accountant is a complete idiot, and here's why. This is your business. Your business turns a profit. Your profit is then taxed. Well, your CPAs and accountants say, hey, convert this to a CRS Corp and then pay yourself as an owner via W-2, 1099, or K-1. Well, that turns into a paycheck, which is also taxed at the highest rate between payroll tax, income tax, Social Security, Medicare, Medicaid. We then lose statistically 60% of your money every time you do this. This is a bad method. What we need to do instead is we need to go back to the business and we need to have the business then kick over a K-1 distribution to an irrevocable spendthrift trust. This irrevocable spendthrift trust will own 95% of the LLC as a non-officer. Therefore, the income is then seen as passive. This spendthrift trust can file the 1041 and defer the taxes on every penny of that by allocating it to the corpus of the trust. Therefore, you can spend the money inside of this spendthrift trust on all of your eligible expenses and all the taxes are deferred. This is how the wealthy completely eliminate their tax liability under their business, because the business alone doesn't have the tax strategy you need. The trust has the tax strategy you need. This is the key.
Oh boy, I need to buy a hat, like a big hat, and then just say stuff that's just patently false.
I prefer the beanie, by the way. I think you'd look better in a beanie, but I think you could rock the cowboy hat.
I like pot guy that wears the funny Rasta hat and stuff. And like, there's some interesting characters out there. I think he calls himself the Wealth Wrangler, that guy. There's so much that's wrong there. It's because he conflates things and he's spouting off words, and words have meaning. So when he says you have an S or a C Corp and your accountant tells you to pay this and it's W-2, 1099, K-1. C Corps don't pay out the K-1s. They're paying you a dividend more than likely. Maybe that might be on a 199 or 1099 DIV, but that's a very different type of tax treatment than other things. You're not losing 60%. Though, let me just be really clear. Statistically, like if I had $1 million in a corporation, it's 21% tax rate, and then it paid it out to me, I'm top rate at 23% on that as a dividend. But come on. If you pay it to me as payroll, it's a deduction of the corporation, and then my top rate is 37%. If I'm in California or New York, maybe you're getting up there, and then you have employment taxes on it, which there's a phase out. It's like statistically, he's all over the place, and he's saying things that are patently wrong. The big one is this idea of having a trust, an irrevocable spendthrift trust. These guys are all over the place talking about this stuff, and they have no idea what they're talking about. And what they're referring to is a provision in the code called 643 that has to do with something called distributable net income. And it's basically this: if I have a trust, somebody has to pay tax on it. Section 61, really clear. You have an ascension of wealth, it's taxable. We don't care if it's if it's an irrevocable trust, if it's an individual, unless there's an exemption or unless there's an exclusion, it is taxable. But in a trust, a lot of times I'll have a trust that requires me to distribute the income out, and I'm distributing it out to the beneficiaries. and it's what they call, it's an accounting methodology. And so what this provision says is basically, hey, you get a deduction for that when you're distributing it out. If it's part of DNI and I'm forced to distribute it out, especially depending on the type of trust, then I might get to write that off against the trust income. But sometimes if I'm the trustee, I might just allocate it to corpus. He called it the principal. That's not what he's referring. That's not what he's thinking. A K-1 comes in, that's taxable to that puppy. If I distribute it, it's taxable to the recipient of the money, and then it wouldn't be taxable to the trust. But if the trust keeps it, the trust pays tax on it. And the interesting thing is there are regs specifically on this that talk about things like capital gains and stuff, all the stuff these guys are always jumping around on and going, look, if you allocate it to corpus, it's not taxable. That is not true. The question is the beneficiary taxed on it or is the trust taxed on it? And the trusts get much worse treatment for tax purposes. I think it's like $11,000 and you're in the highest top, that you're in the top bracket. So everybody thinks that rich people do this. No, they don't. They do not do that because that is illegal. They might have trusts. They may be saying, hey, let's distribute it out, or they may say, let's keep it in the trust and let the trust pay tax on it in some cases. But it's never hey, we made a bunch of profit in the business and it's an irrevocable spendthrift, non-grantor trust. No, they tread all over the rules. And again, it's that thing that words have meanings and they don't understand what they mean. So they just spout them off and they have no idea what the heck they're talking about. And so when you say your accountant's an idiot for what? For you paying your taxes? I don't even know what to say. Imagine that guy probably poses next to really nice cars and flexes and says, look, you can be rich like me. And eventually he'll end up inside of a federal penitentiary and we'll be paying for his upkeep.
Yeah, it's a really interesting.
With our taxes.
with
our voluntary taxes.
With our voluntary tax system. What's interesting is wealthy people use trust and irrevocable trust, but you're saying it's not someone's got to pay the tax, and usually the beneficiaries will be paying tax on that. You're saying where they're really being misleading is they're saying you can use it for corpus. And another thing that they talk about is like now the trust, since you're the trustee, the trust can buy clothes and it can buy houses for you. It's like anything that's, I don't know, they almost go like the ordinary necessary, like anything that benefits the trustee, you can use it. So they would say that you're not getting income. That's the loophole, Toby. It's you're spending money through the trust. And if it's not in things that check the box, it's like a way to not have paying taxes on the front end and on the back end. Is there an element of truth to that, or is that just plainly misleading?
This is plainly misleading. When you have ascension of wealth, when there's a transfer of value, it's taxable. Courts have been very, very clear on this stuff. And so if I'm giving you something of value, I can't just say, hey, it's a business deduction. No, it's not.
Yeah. Okay.
They just distribute it out to you so that, my argument would be the beneficiary received that value. That's who should be paying tax on it.
Yeah.
I suppose that there's a twisted theory where you'd say, well, it's really the corpus or the trust that should be paying it. And I'd be like, well, okay, if it's disallowed as a deduction as distributable net income, then the corporation will pay tax on it, or not the corporation, the trust will pay tax on it. But I would say, like, if you're paying a bunch of personal expenses, that's no different than if my business buys you a car.
Yeah.
Caleb, if I went out and I just said, hey, Caleb, here's a Ferrari. Let's say you're not even the owner of the business. You just work for my business and you're such a great worker. I buy you a car. That's payroll. I'm sorry. That's a bonus. That's going to be subject to withholding. That's going to be subject to employment taxes and federal taxes and state taxes. I can't just say, well, it's a car. I just gave it to you as a gift. It doesn't work that way.
Yeah. Okay. Yeah. No, I appreciate you breaking that down. Very interesting. Toby, I had a blast hearing you watch these videos and giving your reaction. I hope this was as valuable as it is to our audience as it was for me. What would you say for someone who's not a tax attorney, doesn't, commit their profession in like learning this stuff? What would you say if someone's watching something on TikTok or YouTube or Instagram and they're like, oh, this sounds really good. What would your recommendation be as it relates to like proofing it or vetting it?
Talk to a professional. If somebody who's generally, unfortunately, like there's some people that are in there that are probably credentialed professionals that are giving some of this bunk advice, right? You go to I'm a tax attorney, go to a tax attorney, go to a CPA, go to an accountant, and say, hey, here's what I heard. What's the good, the bad, and the ugly? And then understand what TikTok is and what Instagram is. It's entertainment. I'm certain that those guys aren't making money as tax professionals. They're making money with their clicks or whatever they're doing with their social media. That seems to be the primary driver. So they act outrageous. They say outrageous things. Some of them say patently false things. Some of them may be trying to get you to go into a program or whatnot. Go to a disinterested third-party professional and just ask them. And something you could very easily do. And Caleb, I could put a link for them if they want to do this. But at our firm, we do something called Tax Tuesday every 2 weeks. And it's free. You just go in and you could ask questions. There's tax professionals. There's a bunch of CPAs and Elliot. I used to do them all the time. And Barley, these are tax attorneys and CPAs, and Amanda's a tax attorney. These guys literally go through questions that have been emailed in, usually 10 that are kind of like this. And then there's a bunch of accountants that are in the chat you could just ask them a question. You say, hey, I saw this. Is this a bunch of garbage? And watch, they'll look at it and go, just like I did. It takes me literally no time at all to say, well, here's the 3 things that you're missing on most of these, or this is bad, or hey, there's some truth, but here's the reality of it, or, and then you could have a conversation. But that's a free way to do it. I wish I had something to sell you. I don't, but you could go in there and just do that and use it as a sounding board. Again, I'll give you the link, Caleb.
Awesome. Thank you. We'll have the link down in the description. Make sure to check that out. Toby, before we wrap up, any final words? I feel like you've said so many gems so far. Any final words?
Thank you for having me. And there's a lot of bad information out there, and it's tough. It comes at you so fast. The sad part is that most people that are, true tax professionals, they're probably not going out there cutting all these types of videos. I do a fair amount. I know Jasmine's out there doing a bunch of these, and some people like the reaction videos. It's usually not really something someone's going to go do. Jasmine does a ton of them. I know she loves to do that. She's a great person from what I can see. Usually it's the loudest people are the ones you probably shouldn't be listening to, and just vet it out. Vet it out. Find a good group of people that are disinterested. I can't say that enough, that aren't trying to sell you something, and just go in there and say, hey, what do you think of this? And then they'll usually give you a straight answer.
Yeah. Toby Mathis, thank you for your time.